Good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It's Wednesday, April the 26th. I'm delighted today to be joined by Narendra Taneja, India's leading energy expert, Clyde Russell, Asia Commodities and Energy columnist at Thomson Reuters, and Paul Hicken, editor-in-chief at the Petroleum Economist. Thanks, everybody, for joining us. I'm not sure if I can see Clyde and Narendra on camera, but they'll appear soon. I know they're with us. Paul, let me start with you. We can see, our viewers can see the headline, obviously bulletin headline there, and also a survey result that we had this week on the program, which shows the level of confidence on OPEC, on sort of the more recently announced, I suppose, OPEC plus cuts, which are kicking in supposedly in May, 1.6. Let me ask you, how confident you are that we're going to see those even start to show as early as May, let's say. I'm sure they'll filter through. About 60% of our audience are very confident there, that they will be implemented. And what's your reading of the market's belief in that pledge?
I think the market certainly believes it. I think you see it with the fact that there's really a two-speed OPEC plus right now, those that can and those that can't affect output. And those are the ones that had this voluntary cut. We saw the market reaction when we had the spike in prices straight afterwards. It may not have been enough to change sentiment, given the way that the economic outlook, the fears around the banking crisis are still there, and that demand is really the driving seat. But how the market read the OPEC plus cuts is another matter. How much it was seen as a bullish signal and how much it was seen as a bearish signal in terms of trying to stop the rot, so to speak. But I think the market and most analysts would say they're confident that there's the ability of the key Gulf producers who have always had that power. And it almost feels like we're moving to a two-speed OPEC plus where those Gulf producers can influence and can move in a different way. And I think probably the bigger question is if we don't have the floor, that we talk about this $80 barrel floor, and I think the bigger question is is that going to hold if we get another banking crisis, if the fears over the higher interest rates and demand kick in further, does OPEC plus have the patience, since they moved quickly one time, to move again? And I think that's going to be a question if prices do drop and test that floor to a significant degree.
Okay, thanks, Paul. Clyde, let's talk a bit about that floor in the context of what may keep us there and rise above that. Chinese demand, I mean, the first quarter performance of the economy was very good by all intents and purposes. Their oil imports were also very strong. And yet we see the negative headlines of the whole macro story in the West. That seems to be dominating, doesn't it, and pressuring oil prices.
Yes, I think if you were trading oil just on what you're seeing out of China, you'd probably have $80 a barrel as a no problem sort of scenario at the moment. I think you're sort of seeing a bit of concern about what's happening mainly in the Western world, but there are actually pockets of weakness in Asia. One of the things that I find quite interesting is I was trying to look at the whole Chinese picture rather than just the import picture. Yes, imports were up fairly strong, about 700,000 barrels per day in the first quarter. So that's in line with the sort of forecast from OPEC Plus, from the IEA, from some private analysts, that we're going to see fairly strong import demand growth in China. But there are all sorts of other caveats that the market tends to ignore. Exports of refined products were also up by about 60% in the first quarter, or about 610,000 barrels a day. So if you say that crude imports went up 700,000 barrels a day, but the refined product exports went up 610,000 barrels a day, just how strong really was Chinese demand? Especially when you then throw in the other factor of how much were they putting in inventories. And the answer is quite a lot. They're putting about 700,000 barrels a day into inventories as well. So that doesn't really give you a picture of terribly strong Chinese domestic demand. It actually gives you a picture of them running the refineries quite hard in order to capture export market. And it tells you that they're also putting quite a bit of crude into storage, because the amount of crude available from domestic output and imports exceeded the even very strong amount of refining that they've been doing. So, I tend to say, if you look at the whole totality of the Chinese picture of imports, exports and inventory flows, you get a very different picture to what the market is currently thinking it's seeing.
And Clyde, just to follow up on that, would you expect that Chinese performance, let's say, that pattern that you just described, to continue? Or what would stop that from continuing for the whole year, if anything?
Well, I think what the Chinese have effectively done from the start of this year is they've given themselves options. And that's what the market doesn't really understand, is if they see the price of oil at a level that they are comfortable, I can actually foresee a circumstance in which their imports will increase quite dramatically. And that they will have a very strong second half. If the oil price remains above $80 and heads even further north, I can foresee a scenario where they say, well, let's import what we have to, but we'll dip into stockpiles because, boy, we've got plenty of those too. So what has happened in the past is the Chinese don't talk about this. They don't talk about their inventory levels. They don't talk about how they're going to use them. They just do it. So what you actually have to do is follow the data very closely. Now, if you actually start to see their imports sort of stagnate around that 10 to 10.5 million barrels a day level, then what you're really getting is a scenario where they're not actually driving the market on an import growth. But that, you have to wait till you see the data. I mean, some of it we can see fairly in real time, but you have to see what they're actually doing. But what I think that the market really thinks they've got no options. If their economy is going to go strongly, they are going to have to import. I'm saying they have options, and as it will be up to them to decide how they're going to use that flexibility they've now built into their system. I think if prices remain high, you will see the Chinese step back from importing from the expensive producers. They'll still try to get as much as they can from Russia and from Iran and Venezuela and the other people who are selling their oil at a discount, but they will step back, particularly from the Middle East, and you're seeing that in India too.
Okay, and perhaps even switch to coal if prices really get too high. Narendra, welcome again. Let's talk a bit about the imports of Russian crude into India, which perhaps doesn't have as many options on the table as China does in its strategy. And talking about Russian oil, we have an article today as well, which says the discount on that is dissipating a bit. Is that at all negative for India, or will it continue to buy oil no matter what?
Well, you see, India's refinery importing oil from Russia, it's basically an economic decision. It all depends on economics. As long as Russians are able to give attractive discounts and also make sure that, crude is shipped to Indian ports and they take care of logistics, including insurance and all that, in partnership, of course, with Indian importers, and still the price is attractive, the India refiners will go for that. I mean, it has nothing to do with politics or India's stand on Ukraine and all that, as some, columnists and writers, they keep on, and politicians keep on saying. Nothing to do with it. It's purely an economic, a decision based on economics. So far, the economics is attractive, and India's refiners are very happy to import, both the public sector, the government companies, and the private sector company. They're importing because the, discounts are attractive. But at the same time, yes, we have seen reports, that Russia now is basically cutting on discount in the sense that, that space is shrinking a bit. But it all depends on politics. It all depends on demand supply fundamentals globally. So my sense is, so far, as of today, when we look at this, it is still working fine. In fact, now India is importing, if you look at India's import basket, roughly 28% crude is coming from Russia. And refiners seems to be fine, because we are also exporting products from India to all over the world, including the US and Western Europe, is Russian oil, which is coming to India, refined, and then exported to the very same country which have imposed sanctions against Russian oil. The only difference is not crude, is petrol, diesel, turbine fuel, and and so on and so forth. So that's the change. But as I said, but at the same time, India's import from Iraq and Kuwait and Saudi Arabia, Nigeria, the United States are also in place, because India follows a strategy to diversify supply sources. Even if Russia offers more discount, I don't think beyond a point Indian refiners are going to depend only on one source. Call it Russia, call it Saudi Arabia, call it Iraq, or call by any other name. So that's the strategy. But so far, Russian oil is attractive. We don't have pipelines and rail system and all that like China. We are kind of, it has to come by sea only. And so ships are important, insurance important, risk to ships important, and there's many other factors. But so far it has worked well, and Indian refiners are going ahead with it. What happens next week, tomorrow, We'll have to wait and see.
Wait and see. Paul, back to you. Just on the sort of cuts, if you like, volumes that we've already been talking about this morning, the 1.6 of the voluntary cuts that OPEC pledged, is the market sort of taking, obviously, assuming that 500,000 of that kind of is Russia's pledge also, that it voluntarily came out. But do we see the evidence of that in the market at all yet, but from Russia, from what you're seeing? Or will we see that 500,000 essentially be cut this year in general? I mean, what's the feeling of Russian volumes again, which aren't maybe all, very transparent?
Yeah, it's funny, isn't it? The whole Russia situation, in a sense that everyone expected since back a year ago that this huge amount of Russian volumes were going to come off, and they never really transpired. And even with these voluntary or not voluntary cuts, however you want to call the Russian reduction, not necessarily, it's probably that part of the OPEC plus equation that's probably most at doubt of that 100% that's going to come off. I think you've got all the Saudis, UAE, pretty reliable. They're going to reduce output come May, but actually the Russia one is the biggest one probably in question out of everyone, and everyone's trying to second guess the situation in terms of how much Russian barrels are going to come off. And even for OPEC plus itself, within the group, it'll be an interesting one, a dynamic to see if that really transpires and how much that galvanizes the group as a whole. Often there's an
article, sorry, just to interrupt you there. There's an article on our bulletin today saying that Russia is now considering cutting the subsidies it's been giving its refiners to help them with, obviously their restricted exports and pricing there because of budget, needs on its part. It's just a consideration. But if that is implemented, what impact will that have directly on product exports, let's say, which are kind of under these sanctions already?
Well, I think
from a price point of view, how will that influence possible export volumes, do you think, if it's implemented?
I think it's very hard to say right now because you still have such flexibility in the market with the Russia part of this equation it's unlikely to be a huge in volume. The market's already factored in a lot of this cut. It's part of this is about what gets priced in terms of sentiment, in terms of risk. And at the moment, those risks aren't really quite there. The questions around gasoline shortages in the summer months now, that doesn't look like it's going to be happening. We've seen record volumes of US crude coming to Europe. That's getting turned into gasoline. The diesel crisis, which we saw, or fears of a diesel crisis, which we saw, and shortages back last year, that's dissipated as well. So I don't think we're really in that situation where those product shortages are quite there right now, and especially given the way demand is, especially where, I think what really has changed, and what changed from about a month or two ago, is that the market hadn't really priced in the same economic weakness in the OECD countries in the West, and that with the banking crisis, that's flipped on its head. Everyone was looking at that, now has been inverted, and everyone's looking at the OECD and how high interest rates are going to go, what strain that's going to put on the system, and how much is that going to impact demand, because otherwise the supply side hasn't really changed, and there's still those uncertainties there.
Yeah, Clyde, on that point of sort of macro policy impacting demand, and now the market's believing it's in prices, the whole interest rate pressure is coming on board, and of course that's probably why we saw all that short selling coming in more and more, recently, and OPEC coming in to cover for that. But for let's look at the second half of the year. This whole second half year is going to be stronger, generally speaking. Do you sense that the market, now that it's pricing in everything, is more confident about the macro trajectory for the second half of the year for the world, if you like, and therefore we'll see more traders come in and buy and lift that price up? Do you think that confidence is returning?
No, actually, I think it's probably the other way. I think they're getting more confident that things are going weaker. I think you're sort of starting to see that the rapid and sustained monetary tightening in much of the developed world is starting to really crunch down on those economies fairly hard, and that's going to continue. At the same time, you still have your main sort of producer group for oil, the OPEC Plus group, working very hard to keep the price above 80. Anytime it sort of looks like it's going below that, they come out, cut output, crunch the shorts in the paper market, and do that sort of thing. So the world economy at the moment is not really set up to handle $80 a barrel oil. I think it probably needs it closer to 60. And the longer that OPEC, artificially keep the price up at 80, the worse the situation is going to get. The more confident people are going to be that in the race between OPEC Plus and a global recession, the global recession is going to win. The one thing that is your unknown X factor is just how strong China will be in the second half. Logic tells me that China won't be strong if the oil price is high. It will import more if the oil price does fall. That much is virtually guaranteed. But if oil price remains high, it might not import more. Also, the Chinese economy is still fairly connected to the rest of the world. They're not going to be doing well if the rest of the world is crunching back on consumer spending. That's a lot of their economy is manufacturing exports. And if that starts to stumble, they're not going to be able to replace that with domestic retail sales or housing construction. What we're seeing in China at the moment is a very uneven recovery. It's quite a bit unlike what we've had in the past. They have chucked massive amounts of stimulus spending, but they haven't really kind of got the uptick in their construction and infrastructure sector that they have in the past. Right now, the retail sector looks quite good, but the other sectors are still very mixed. And that's not something that we're used to seeing when they try to stimulate their economy. So if you add in the idea that China may not be as strong as everybody thought at the beginning of the year, and even the most recent forecast from the IEA, OPEC Plus, if you say that, and then you add in the OECD and the other developed countries and the rest of the developing world, Latin America, Africa, not looking that crash hot either, it's really hard to see how you can get a sustained rally or even keep oil prices at their current level. OPEC Plus, again, it's as Paul says, how much are they prepared to keep cutting? And, in order to keep the prices, or at what point do they just give in and say, well, hang on, we'll chase market share and we'll push all those other producers out?
Yeah, back to that formula again. It's a fine balance, isn't it? They need to keep people buying the oil, don't they? So it's and yet many people are convinced $80 minimum. They will always support that because of their planned budget expenditure, except especially countries like Saudi Arabia.
It comes down to support $80 now, have to deal with $40 later. That's the kind of choice that they will ultimately face if the world economy is as soft as we think it's going to go.
Yeah, and doesn't have the soft landing, I suppose, that most people were hoping for. Narendra, I mean, you mentioned that India will take oil at the right price, and and that it's not political. And yet, you are as a country taking Russian crude when it's under embargo or sanctions from the West. India's relationships with the West are obviously very important, and India seeks the West support in its stance, sort of against China, if you like, in terms of regional power. Does the country have any qualms or doubts about how it can balance those two interests? We want the West to support us in our stance against Chinese hegemony, and yet we're going to do what we like and ignore what the rest of the world is doing. Today, 2023.
I find the question funny in the sense that, look, there are 1.40 billion people in India. That's more than the entire population of the so-called rich world, or the so-called global north, and Europe and America put together. And India is a sovereign country. I mean, you can impose sanctions against anyone, but you're not the United Nations. Sanctions have not been imposed by the United Nations. That's a decision of G7 and some Western countries. We respect that, but we have our own foreign policy. We have our own view of China. We have our own view of Russia. And the same way, we have our own view of OPEC. I mean, you are talking about OPEC and all that. That's not how we look at OPEC. We are a major importing country, the third largest consumer of oil in the world. We track OPEC very closely, probably more closely than Germany or Western Europe. We do that because what happens in OPEC, within OPEC and within OPEC Plus, that's very important for us. So we look at the whole situation very differently. For us, it's very important that the Gulf, which is a major, area in terms of oil exporting countries, GCC countries, and even countries beyond GCC, political stability in that part of the world is very crucial for us. We have more than 10 million Indians living and working there. We have our economies are quite integrated. We are a huge exporter of services and manufacturing goods to the Gulf countries. We also import heavily from there. So if that means that they need oil, let's say for the sake of discussion, at $70 per barrel, but in return, they make sure that political stability is there, social stability, economic stability is there, and therefore Indians who live there can continue to grow, continue to prosper. That's not a bad economics. And at the same time, that it doesn't create any kind of political vacuum, which attracts countries like China into that region in different forms and shapes. So you see, oil, the way we look at it is oil is not just looking in front of the computer and looking at demand and supply graphs. Yes, that's an important component, demand supply, but it's more than that. That's how we view it. And for instance, Ukraine, you said about it, that was when Western countries took the decision to sanction Russian oil, did they consult India? They didn't. Then what they do with the sanctions and all that is, and how we look at Russian oil is none of their business. We are a sovereign country.
Yeah,
we are not. No, but just 1 minute. It's important to understand the world is. No, listen. Let me complete. World is not only the West. West is only 1.3 billion people. World is also 6.7 billion people. OPEC is not only how Europe looks at OPEC. OPEC is actually more than how we look at Europe. OPEC, how China look at OPEC, how China look at Russia, how India look at Russia, how Turkey look at Russia. That's more important. The problem is in Western part of the world, you people just don't forget about seeing, you don't acknowledge, you don't see. For you have your own world, and that's how you look at it. But the world has changed. You're not realizing the gravity center of energy is in Asia, it's not in the West. So wherever you are, it's important to keep that in mind.
It certainly is. And we'll talk a bit about US production, actually. But Paul, just back to you, let's talk a little bit about gas in Europe. And we had an interview yesterday, which we'll be bringing up later today, actually. And we were talking about Europe and how it's now today, in 2023, a year on from the Russia war, how it's looking at the gas sort of, I suppose, story for it in the year ahead. And is there a risk that Europe has become now complacent with sort of looking forward to securing those supplies? It did the right things last winter, it had a warm winter, etc., got through it. Is it well placed for the next year or two in terms of more independence from Russian supplies?
That's a good point, and I wouldn't say it's necessarily complacent. I think there's a warning sign still there, because if they do get enough storage at 90% level going into the winter, there's still not enough storage to offset a very cold winter. So there's still that risk there. Europe has been working very hard at getting the regasification units, the infrastructure in place so they can import more LNG from the US and elsewhere, which they did last year, but they want to ramp it up even further. They're trying to get it in place. Some of that's not going to come online till next year, so there's that in place. So Europe is still vulnerable. I don't think it's necessarily complacent, but the problem is that when prices are lower, it's the incentive to store, the incentive to buy, it drops, and the incentive from elsewhere comes in, and you're going to have a little bit of a battle on your hands between Asia and Europe this time around. If China demand comes back strong again, that wasn't the case last year. So Europe got a little bit fortunate with weather, with China, and that's not going to be in place. So even with that storage level, even with the new infrastructure, there's still huge risks. And I think,
and of course, if the prices drop low enough, you're going to have people coming into industry back turning its engines on again, aren't you? So
demand ramps up as well, and that again, prices impact demand. You're not going to have the same restraint of demand. I think there's lessons to be learned from the way gas and oil are related in this. And I think what Narendra was talking about with India as well, which is another factor about that, is that India doesn't have the SPRs that say China, or strategic reserves that the West do, that the US has been having, that China has. India has been trying to start building out its restricted stocks, but doesn't have it. So it's a much more vulnerable in that sense as well to the flows of supply. And that's the same with the LNG market as well, that the storage isn't quite there that have in the oil markets, the IEA mandated stocks in place. LNG doesn't have that, so you are much more vulnerable to spot flows.
Okay, let's just look at that survey question, which goes back to oil. With prices still hovering around 80, is it likely that OPEC will announce further cuts ahead of the second half of the year? I mean, Clyde was painting a negative economic picture there, that the market is now actually expecting even weaker sentiment there. And yet some people would say, well, OPEC will defend the price, and if we start seeing it going down, maybe they will bring in more cuts ahead of second half. So agree or disagree, and we'll see that result come up. Clyde, let's just talk about, stick to gas a little bit and talk about LNG, and then US sort of supplies which came into Europe last year. They weren't needed in China and Asia as much. But your point of view on that, obviously we don't know how things are going to go economically, but if China does come back a bit stronger than it has, or maintains this level of 4%, etc., will we have a challenge with gas supply for Europe and Asia? And how will the US be impacted by that in terms of its current inventories that it's got to spare?
Well, I think it all really is a price-driven thing. You've got quite a number of price-sensitive buyers in the Asian region, especially for the spot cargoes. So, China takes a certain amount of LNG under long-term under long-term, mainly oil-linked deals, although it's got a really sweet deal with one of the major Australian producers. That is coming to an end, by the way, in the next couple of years. But nonetheless, China will buy spot cargoes if the price is right. What does the price right mean? It certainly means below $15 per MMBTU, more likely below 10 is where the Chinese want to buy those spot cargoes. Any more than that, and they struggle to make a profit selling it into their domestic market. So, the incentive disappears. For India, for Pakistan, for Bangladesh, for the other price-sensitive LNG buyers, the lower the price, they will come back into the market. So I would expect to see over, the sort of shoulder season that we're in now, that those countries will actually secure some spot cargoes at reasonable prices. But if we go into the northern winter, towards the end of the year, and you're getting a more normal winter in Europe and a more normal winter in North Asia, and there's some competition for fuel, then you're going to see those price-sensitive buyers kicked out. And actually, China counts as a price-sensitive buyer. They'll rather use coal for heating than gas if it comes down to it. So my own feeling is it really depends on the price. If there's enough supply, there is new LNG supply coming in. If there's enough to meet everybody's needs and to keep everybody happy and the price is good, then you'll still see that sort of volumes going into Asia. But if the price rises too much, Europe will win that particular price war because they will pay no matter what the price. We've seen that already.
So Europe, even though it may feel a bit more comfortable today, will pay anyway, as it did last year, in terms of, yes, It may have turned into a bit of complacency now, but it'll cough up if it needs to. We just see that survey result there that disagrees. So 62% disagree that OPEC will do that as soon as ahead of the second half. Of course, we're not even going to see those voluntary cuts evidence in the market until then. So probably unlikely. But then again, the last announcement was a surprise. Narendra, just before we wrap up, a couple of minutes just to go to. We had an interesting article. Actually, I don't know if it's on the bulletin, but I was reading this article that the BRICS nations, which have their next meeting in June in South Africa, are inundated with new applicants to join the bloc, as you said. And so will we be, seeing the BRICS nations, which includes India, obviously welcoming that? And, in your opinion, how will that be received by the G7 economies? Neutral? Would they be bothered? Where do you see that going in terms of?
Well, good question. You see, these are not very kind of straight lines. India is very closely aligned with the West. We are very close to the United States. We are very close to NATO members. We are very close to Britain, close to European Union, Japan, Australia, and OECD countries, for the obvious reasons. So we are very, very closely aligned. We even have got an organization called the Quad, where India, Japan, Australia, and the United States are working together, and Chinese call it the southern NATO or etc. So on the one hand, you have this picture, but at the same time, it's important for India that we keep on asserting our sovereign strategic autonomy in terms of our relations with China, our relations with Russia, and also our relations with the BRICS countries. So therefore, BRICS become very important. And let's not forget, India is also hosting a SCO summit, which is an organization initiated first by Russia and China. Now India is a very important member of it, and we are hosting the summit. The Chinese president, Russian president, they will all be coming to Delhi for that summit. So, you know, for us, the important thing is that, you know, on the one hand, BRICS, more members are welcome. It doesn't really matter what G7 thinks about it, because we have very close ties with all the G7 countries at the same time. So unlike China or Russia, India is in a very different space. We are in a space where on the one hand, we have very, very close ties, almost brotherly ties with the Western countries. At the same time, we have historical close ties with Russia. With China, we want to have a good ties, but China has its own idea. We want to make sure Asia is multipolar. China wants a unipolar Asia. So we have this conflict. Plus, they have occupied some of our territory up in the mountains in the Himalayas. So there is a dispute and there are disagreements. There's a lot of heat between the two countries. And at the same time, India represents the entire global south practically. Countries in Africa, Latin America, Asia, the developing countries, India is their voice. If India is not the voice, which country? I mean, no other country has the kind of credibility to. So India speaks on behalf of all these countries, you know, with G7, within G20, and also in other platforms. So SCO is expanding, you know, and BRICS is expanding. We hope that G7 will answer. G7, I mean, India is the 5th largest economy in the world, but India is not a member of G7. It's funny in the sense that, you know, we are actually much bigger economy than Britain or France. And in 4 years, India will be the 3rd largest economy, overtaking Japan and Germany both. But G7, I mean, so that's a different kind of club. So, but as far as we are concerned, we want to be sure about we want to protect our, you know, strategic autonomy. And we are an independent pole. We are not ally. We are not kind of, you know, follower of any bloc. And we follow that. So West needs to understand, OPEC needs to understand that. And at the same time, China and Russia also need to understand it. India is a huge country, a big emerging power. And by 2050, India will be the 2nd largest economy humankind has ever known. So please keep that in mind, and potential of India.
We are, and there's no denying that at all. And as you said, those blocks of why is India not in the G7? A lot of those economic and political blocks probably need some adjustment given the current geopolitics. But thank you so much. We've run out of time, gone over time even. Narendra Tanea, Clyde Russell, and Paul Hicken, thanks so much for joining us today for the Daily Energy Markets podcast. We do have in an hour coming up halftime talk, our weekly interview with Amrita Sen there, which is an interesting one to tune into. I'd encourage you to do so. She's quite bullish that of the second half of the year, and she thinks it's just sort of technical hesitancy right now, but the fundamentals remain quite strong. So thanks everyone for joining us today, and have a great remainder of Wednesday. Thanks. Bye-bye.
Thanks a lot.